Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not a substitute for professional advice from a qualified expert who can assess your individual situation. Always consult with a licensed professional before making any financial decisions, especially regarding your insurance coverage. Your needs are unique, and the insurance world can be complex and is constantly changing. Imagine this for a second. You're driving home from work. Maybe you're thinking about what to make for dinner, and for just 1 second, you glance down to change the song on your phone. The moment your eyes return to the road, you see nothing but red brake lights. You slam the pedal, you hear that horrible screech of tires, but it's too late. It's a minor fender bender, nobody seems hurt, but the car you hit is a brand new Mercedes. The other driver is a lawyer, and you've just made a mistake that's about to cost you your life savings. Not because of the accident, but because of a decision you made 6 months ago, sitting at your kitchen table trying to save $20 a month on your car insurance. This isn't a scare tactic. This is a reality for thousands of Americans every single year. We live in a country where you are financially responsible for the damage you cause, and the gap between what people think their insurance covers and what it actually covers is a financial time bomb waiting to explode. A recent study found that nearly 40% of insured drivers in the United States don't fully understand their own policy. They believe they have full coverage, a term that is dangerously misleading, when in reality, they are one unlucky moment away from having their wages garnished, a lien put on their home, and their entire financial future thrown into chaos. This video is the cure. We are going to expose the 5 most catastrophic, wallet-draining, and surprisingly common mistakes people make when buying car insurance in the USA. And we're not just going to list them, we're going to dissect them. I will give you the knowledge and the exact language to use so you can protect yourself, your family, and everything you've worked for, potentially saving you thousands of dollars in the process. This is the conversation your insurance agent might not have with you. So let's get into it. The first, and by far the most devastating mistake, is falling for the state minimum trap. It sounds so official, doesn't it? State minimum. It sounds like you're being a responsible citizen, following the law, and doing exactly what's required of you. And that is precisely what makes it the most insidious trap in the entire insurance industry. Every state, except for a couple of outliers, requires you to carry a minimum amount of liability insurance. This is typically broken down into 3 numbers, something like 25/50/25. This means your insurance will pay up to $25,000 for bodily injury to one person, a maximum of $50,000 for bodily injury for the entire accident if multiple people are hurt, and $25,000 for property damage. On paper, it looks like a lot of money. In the real world, it's a financial death sentence. Let's rerun our scenario. You live in a state with a $25,000 property damage minimum. You hit that new Mercedes. The bumper is crumpled, the advanced collision sensors are destroyed, the headlight assembly is cracked. The initial estimate from the Mercedes-Benz dealership comes back at $32,000. Your state minimum policy pays out its maximum of $25,000, and the insurance company wishes you the best of luck. You are now personally on the hook for the remaining $7,000. But wait, while the car was in the shop, the owner had to get a rental car for 3 weeks, which cost another $2,000. Now you owe $9,000, and that's a relatively minor accident. What if you don't hit a Mercedes? What if you swerve on a wet road and hit a brand new Ford F-150? The average transaction price for a new vehicle in the United States is now over $48,000. Your $25,000 in coverage is a joke. It's not even a down payment on the damage you caused. Who pays the remaining $20,000, $30,000, or even $50,000? You do. Out of your pocket, your savings account, your 401k, your kids' college fund. It's all fair game when they come to collect. And that's just the damage to the car. We haven't even talked about the most expensive part, the people. Let's say your state's minimum for bodily injury is $25,000 per person and $50,000 per accident. In that Mercedes are a driver and a passenger. The driver gets a back injury. The passenger gets severe whiplash. The ambulance ride alone can be over $2,000 per person. The emergency room visit with CT scans and MRIs can easily hit $15,000 each. We are already at $34,000 in medical bills before they've even seen a specialist or started physical therapy. Your policy's limit for the entire accident is $50,000. But it gets worse. Since the driver's injuries are more severe, Your policy might pay out the $25,000 maximum for him, leaving only $25,000 for the passenger. But what if the passenger's bills are also $25,000? Now your total policy limit of $50,000 for the accident is completely exhausted. And that's when the letters start arriving. Not from the hospital, but from their personal injury attorney. They won't just be suing for the medical bills. They'll be suing for lost wages because they couldn't work. They'll be suing for future medical costs. They'll be suing for pain and suffering. And that lawsuit won't be for $50,000. It will be for $250,000 or $500,000. And since your insurance company has already paid its legal limit, they are no longer obligated to defend you. You are on your own, facing a legal team whose entire job is to take everything you have. So why do people do this? Why do they choose these dangerously low limits? The answer is simple: because it's the cheapest option on the screen. People see the state minimum and think, I'm a good driver, an accident will never happen to me. And they click the button to save $18 a month. They treat insurance like a utility bill, something to be minimized, instead of what it really is: a fortress designed to protect your entire financial life from a single bad day. So what's the solution? You need to perform a mental shift right now. Stop asking, what is the minimum I need to be legal? And start asking, what is the minimum I need to be safe? For the vast majority of people, the answer recommended by nearly every financial expert is a liability limit of at least $100,000/300/100. That's $100,000 for bodily injury per person, $300,000 for bodily injury per accident, and $100,000 for property damage. This is the level where you can actually breathe. This is the level that can cover a serious multi-car accident with moderate injuries and not result in you losing your house. And I can hear you thinking it right now. That sounds way more expensive. I want you to challenge that assumption. The next time you shop for insurance, I want you to get a quote for the state minimum, and then get a quote for $100,000/300/100. The price difference is almost certainly not what you think it is. In many cases, you are talking about the price of a couple of fancy coffees a month. We're talking $10, maybe $20 more per month to increase your property damage shield from a pathetic $25,000 to a robust $100,000. Is your entire financial well-being worth less than your monthly Netflix subscription? Of course not. Choosing state minimum coverage is like showing up to a sword fight with a butter knife. You might be technically armed, but you are not protected. Upgrading your liability limits is the single most important, highest impact thing you can do to secure your financial future. But here's the scary part. Even if you have fantastic liability coverage like $100,000/300/100 or even more, you could still be completely exposed to the single most common risk on the road today. There is a second mistake that millions of well-meaning, well-insured drivers make. It involves a different kind of coverage, one that protects you from the very people who made the first mistake. And ignoring it is like locking your front door but leaving all your windows wide open. This is mistake number 2: underestimating the enemy. The enemy I'm talking about isn't some shadowy figure. It's the person texting while driving in the lane next to you. It's the driver with 2 bald tires who just lost their job and let their insurance lapse. It's the shocking number of people on the road who are, legally and financially speaking, ghosts. They have nothing to lose, and if they hit you, they will vanish, leaving you to clean up the wreckage of your car, your health, and your finances. The mistake is failing to buy protection against them. It's called uninsured and underinsured motorist coverage, and treating it as an optional extra is one of the most financially catastrophic gambles you can make. Let me tell you about a woman named Jessica. Jessica was the kind of person we all strive to be: responsible. She had a good job as a graphic designer, a modest savings account, and she always paid her bills on time. When she bought her car insurance, she did what she thought was the right thing. She got liability coverage that was double the state minimum. She felt protected. She felt secure. One rainy Tuesday afternoon, she was driving home, stopped at a red light, listening to a podcast. Suddenly, the world exploded in a symphony of screeching metal and shattering glass. A pickup truck, going way too fast for the wet conditions, had slammed directly into the back of her sedan. The impact was so violent it shoved her car into the intersection. Dazed, with a searing pain in her neck and back, Jessica's first thought after the initial shock was, "Thank God I have good insurance." And thank God it was clearly his fault. The other driver, a man in his late 20s, was apologetic. The police report clearly stated he was 100% at fault. Case closed, right? The system works. His insurance will pay. Except for one tiny detail. He didn't have any. Not a single shred of coverage. He'd been driving on a suspended license with no insurance for 6 months. Suddenly, Jessica's world tilted on its axis. The at-fault system she had trusted in had a gaping loophole, and she had just fallen through it. Her car was totaled. The tow yard fees were piling up. The ambulance ride and the emergency room visit alone cost thousands of dollars. Her doctor told her she had severe whiplash and 2 herniated discs in her back. She would need months of physical therapy and couldn't sit at her desk to work. The paycheck stopped coming in. She called her own insurance company, desperate. She explained, "The guy who hit me has no insurance. What do I do?" And the agent on the other end of the line asked the question that would define the next 2 years of her life. "Did you select uninsured motorist coverage on your policy?" Jessica's heart sank. She vaguely remembered seeing that option. To save about $12 a month, she had unchecked the box. $12. Because of that one click, her own insurance company couldn't do anything for her medical bills or lost wages. Her liability coverage, the part she had paid so much for, was designed to pay for damage she caused to other people. It offered zero protection for her own body when an uninsured driver injured her. Her health insurance covered a portion of the bills, but she was still left with thousands in deductibles and copays. She couldn't work. Her savings evaporated in a matter of weeks, swallowed by rent and medical debt. She ended up having to sue the other driver personally, a long, expensive, and emotionally draining process. And in the end, she won a judgment for over $100,000. Piece of paper. The driver had no job, no assets, nothing. He declared bankruptcy. Jessica never saw a dime. She lost her car, her savings, her financial stability, and a piece of her faith in the system. All because she tried to save $12 a month. Now let's rewind. Let's imagine that same rainy Tuesday. The same horrific crash. The same uninsured driver. But this time, when Jessica set up her policy, she spent the extra $12. She checked the box for uninsured motorist bodily injury coverage, and she set the limits to match her own liability coverage, $100,000. In this reality, after the crash, she makes the same call to her insurance agent. But this time the agent says, "Don't worry, Jessica. You have uninsured motorist coverage. We've got you." Her own insurance company essentially steps into the shoes of the uninsured driver. They pay for her medical bills. They compensate her for the wages she lost while she couldn't work. They cover the cost of her extensive physical therapy. They even provide a settlement for her pain and suffering. Her life is still disrupted, yes, but not destroyed. She can focus on healing, not on fending off debt collectors. She is made whole again. All because of a coverage that costs less than a Netflix subscription. You might be thinking, that's a sad story, but what are the odds? The odds are terrifyingly high. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. That's nearly 13% of the cars you see on your daily commute. In some states, it's much, much worse. In Mississippi, it's nearly 1 in 4. In Florida, Michigan, and Tennessee, it's 1 in 5. You are sharing the road every single day with millions of financial time bombs, and your liability insurance is not a bomb shield. Uninsured motorist coverage is. And it has an equally important twin brother. Underinsured motorist coverage. This protects you when the at-fault driver does have insurance, but they only have the bare minimum required by law. Let's go back to Jessica's crash. Imagine the driver had insurance, but it was a state minimum policy with only a $25,000 bodily injury limit. Jessica's medical bills and lost wages totaled over $100,000. The other driver's insurance company would write her a check for $25,000, their maximum limit, and wash their hands of the situation. She would still be personally on the hook for the remaining $75,000. But if she had underinsured motorist coverage, her own policy would kick in and cover that difference, all the way up to her policy limit. It fills the gap between your actual damages and the other driver's pathetic coverage. So why do so many smart, responsible people like the first Jessica make this mistake? It comes down to a fundamental misunderstanding. We think of car insurance as being primarily for our car. But the most valuable asset you have is not the 2 tons of steel you're driving. It's your body. It's your ability to work, to earn a living, to provide for your family. Skimping on and UIM coverage is like putting a $1,000 alarm system on your garden shed, while leaving the door to your house wide open. It's focusing on the minor asset, while leaving your most valuable one completely exposed. Here is what you need to do right now. Pause this video if you have to. Pull up your car insurance policy on your phone or computer. Look for the declarations page. You are looking for two specific lines: uninsured motorist bodily injury, UMBI, and underinsured motorist bodily injury, UIMBI. If you see a zero next to them, or if the coverage amount is low like $25,000, you have a serious vulnerability in your financial armor. The best practice, the rule of thumb that every single insurance insider follows for their own family, is to mirror your coverages. Whatever amount of liability coverage you have to protect other people, you should have the exact same amount of UM/UIM coverage to protect yourself. If you have decided that you could cause $250,000 of damage to another person and want to be protected, why on earth would you not give yourself that same $250,000 shield against someone else? The cost to increase these limits is almost always shockingly small, yet the peace of mind it provides is immeasurable. It is the single highest value purchase you can make in the entire world of insurance. You've now learned how to protect yourself from people with no insurance and not enough insurance. You're building a fortress. But there's another mistake, one that's just as common, and it has nothing to do with other drivers. It's a trap hidden in two words on your policy that most people think they understand but almost always get wrong. Getting this wrong can mean the difference between getting a check for a brand new car after a wreck or getting a bill from the junkyard. And this mistake centers on a fundamental misunderstanding of what insurance is actually for when your own car gets turned into a pretzel. So, what is that fundamental misunderstanding? It's the belief that full coverage is a real legally defined thing. It's not. It's a marketing slogan, a piece of industry slang that has tricked millions of people into a false sense of security. And relying on that slogan is mistake number 5, blindly assuming full coverage actually covers everything. When you walk into a dealership or go online and say, "Yeah, just give me full coverage," what you're really asking for is a bundle of separate, distinct policies. And the two most important ones, the ones that deal with your own car turning into modern art, are collision and comprehensive. They sound similar. They are not. Knowing the difference is like knowing the difference between a fire extinguisher and a fire alarm. Both are related to fire, but you do not want to mix them up in an emergency. Let's start with collision. It's the most straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a telephone pole, a guardrail, a building, or even your own mailbox that you swear jumped out at you. The key here is the word collision. Your car was in motion and it struck something. You backed into a pillar in a parking garage? That's a collision claim. You slid on black ice and hit a tree? Collision. You swerved to avoid a squirrel and ended up in a ditch? Believe it or not, that's a collision. If you are behind the wheel and your car's movement results in an impact, collision coverage is your best friend. But what about all the other horrible things that can happen to a car when it's just sitting there, minding its own business? That's where comprehensive coverage comes in. Think of comprehensive as the acts of God and criminals policy. It covers damage to your car from events other than a collision. A hailstorm turns your brand new hood into the surface of the moon? That's a comprehensive claim. A branch from your neighbor's ancient oak tree decides to snap off and crush your roof during a windstorm? Comprehensive. You walk out of the mall to find your car has been stolen? Comprehensive. Vandalism, fire, flooding, hitting a deer. All of these fall under the comprehensive umbrella. Here's where people get into trouble. They either cheap out and only get one, or they assume their full coverage has both without checking the fine print. You need both. Period. But just having them isn't enough. Because inside both of these coverages lurks a monster waiting to take a bite out of your wallet. The deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single dime. Let's say you have a $1,000 deductible for your collision coverage. You have that fender bender, and the repair estimate comes back at $6,000. You don't just get a check for $6,000. You have to pay the first $1,000 to the body shop yourself. Then your insurance company will step in and pay the remaining $5,000. If the damage is only $900, congratulations, your insurance is completely useless. You're paying that entire bill yourself. And this is where the real mistake happens. People see the option to choose their deductible, and they treat it like a guessing game. They see that a $2,000 deductible makes their monthly premium $25 cheaper than a $500 deductible. They think, hey, I'm a good driver. I'll save that money. What they're really doing is placing a $2,000 bet against themselves. And the house always wins. Choosing a deductible isn't about how good of a driver you think you are. It's about your immediate financial reality. Here is the single best piece of advice I can give you on this. Your deductible should be an amount of money you could get your hands on tomorrow in cash without destroying your budget, taking out a loan, or maxing out a credit card. If you have to finance your deductible, you've lost the game. For some people, that's $500. For others, it might be $2,500. It's not about what you want to pay. It's about what you can pay on your worst day with no warning. Don't let a $30 monthly savings put you $2,000 in debt when something goes wrong. But the pain doesn't stop there. Let's say you do everything right. You have collision and comprehensive. You've set an affordable deductible. You get into a serious accident, and the insurance company declares your car a total loss. It's totaled. You're thinking, okay, great. I bought this car 2 years ago for $40,000. They'll cut me a check for 40 grand, and I'll go buy a new one. Wrong. So incredibly, devastatingly wrong. Insurance companies do not care what you paid for your car. They don't care what a new one costs. They care about one thing and one thing only: actual cash value, or ACV. Actual cash value is what your car was worth the literal second before the impact. It's the original price minus depreciation. And cars, my friends, depreciate faster than a carton of milk in the desert sun. That $40,000 car you bought 2 years ago might only have an ACV of $28,000 today. That's the number they'll write on the check. Now, for most people, that's frustrating. But for anyone with a car loan, this is where financial ruin begins. Because the bank doesn't care about depreciation either. They only care about your loan balance. And your loan balance is almost always higher than your car's ACV, especially in the first few years of ownership. This is called being upside down or underwater on your loan. Let's put it all together in a real-world nightmare scenario. Meet Alex. Alex buys a brand new SUV for $50,000. He puts a little money down and finances the rest. He gets full coverage with a $1,000 deductible. 2 years later, he's in a wreck. The car is totaled. He's been making his payments diligently, and he still owes $42,000 on his loan. The insurance company does its calculation. They determine the actual cash value of his 2-year-old SUV is only $35,000. That is the maximum they will pay. So, they take the $35,000 ACV, they subtract his $1,000 deductible, and they cut a check for $34,000. But that check doesn't even go to Alex. It goes directly to the bank that holds his loan. So the bank gets the $34,000. But Alex owed them $42,000. You see where this is going? The bank applies the insurance money to his loan, and Alex is still on the hook for the remaining $8,000. Let that sink in. Alex is left with no car, no down payment for a new one, and a bill from the bank for $8,000 for a vehicle that no longer exists. He is paying for a ghost. This is not a rare occurrence. This happens every single day across America, and it is financially catastrophic. The mistake wasn't getting into the accident. The mistake was not understanding the gap between what his car was worth and what he owed on it. And the solution is laughably cheap and simple. It's called gap insurance. Guaranteed Asset Protection, or gap insurance, is a specific optional coverage that pays the difference between the ACV of your vehicle and the amount you still owe on your loan. It's the hero of this story. If Alex had paid the extra, say $10 a month for gap insurance, it would have written a check for that $8,000 difference. He would have walked away from the accident with no car, but also no debt. He would have been free and clear to start over. If you are leasing or financing a vehicle, especially with a small down payment, getting gap insurance is not optional. It is a financial necessity. Don't buy it from the dealership, where they mark it up astronomically. Call your insurance agent. It is drastically cheaper to add it to your existing auto policy. So you've now mastered the art of protecting your physical car. You understand that full coverage is a myth. You know the critical difference between collision and comprehensive. You've set a smart, affordable deductible. You understand the harsh reality of actual cash value. And you've protected yourself from the nightmare of the gap. You're set, right? You've dodged the biggest bullets. Wrong. Because everything we've just talked about, it's all about protecting a depreciating piece of metal. We haven't even begun to talk about protecting your money, your assets, your entire financial future from a single catastrophic lawsuit. And that brings us to the single most expensive mistake you can possibly make, a mistake that doesn't just cost you your car. It can cost you your house. And that brings us to the single most expensive mistake you can possibly make, A mistake that doesn't just cost you your car. It can cost you your house. This is mistake number 2, believing the state minimum is enough. Let me be brutally clear. State minimum liability insurance is not real insurance. It is a legal fiction. It is a piece of paper that allows you to legally drive your car, but it does not provide meaningful financial protection in a serious accident. It is, without a doubt, the single greatest risk the average American takes with their finances, and most people have no idea they're even taking it. So what are we talking about here? Every state requires you to carry a minimum amount of liability insurance. This is the coverage that pays for the damage you cause to other people and their property if you're at fault in an accident. These limits are usually expressed as 3 numbers, like 25/50/25. In a state like California, that's what you're required to have. $25,000 for bodily injury to one person. $50,000 total for bodily injury to everyone in the other car. And $25,000 for property damage. Let's pause on that. $25,000 for property damage. The average price of a new car in the United States today is nearly $50,000. Do you see the problem? The very first time you tap the bumper of a brand new Ford F-150 or a Tesla Model 3, you have already exceeded your state minimum property damage limit. You are already personally on the hook for the difference. But that's just a fender bender. That's not what costs you your house. Let's tell a story. Let's talk about David. David is a good guy. He's 35, married, has a kid, and just bought his first home in a nice suburb. He's smart with his money, always looking for ways to save. When he gets his car insurance renewal, he sees the different options. He sees a policy for $100/300/100, but right next to it, he sees the state minimum option and it's $30 a month cheaper. He thinks to himself, well, if it's the legal minimum, it must be okay. The state wouldn't let me drive with something that was unsafe, right? So he clicks the button. He saves his $30 a month, $360 a year. He feels smart. He feels responsible. 6 months later, David is driving home from work. He's tired. He's thinking about dinner. He gets a text message from his wife. He knows he shouldn't, but he glances down for just 2 seconds. But 2 seconds at 45 miles an hour is the length of a football field. When he looks up, the light is red, and a minivan is pulling into the intersection. He slams on the brakes, but it's too late. The impact is devastating. The minivan is totaled. That's a $40,000 vehicle. David's state minimum property damage is $25,000. So, right off the bat, his insurance company writes a check for $25,000, and David gets a bill for the remaining $15,000. He's stressed, but he figures he can pull it from his savings. It's painful, but manageable. But then comes the real problem. The minivan had a mother and her 2 children inside. The mom suffers a broken leg and a severe concussion. One of the kids has a fractured arm. The other, thankfully, is just shaken up. The ambulances come, they go to the hospital, they have surgeries, they need months of physical therapy. The mom is a freelance graphic designer and can't work for 4 months. The medical bills start to pile up. The first surgery for the mother's leg is $60,000. The physical therapy is another $20,000. Her lost wages come to $30,000. The child's broken arm with ER visits and follow-ups is $15,000. The total medical bills and lost wages for just the mother and 1 child quickly soar past $125,000. David's policy has a $50,000 limit for all bodily injuries in an accident. His insurance company writes a check for $50,000. And then they do something that terrifies David. They send him a letter. It's a very formal letter, and it essentially says, "We have fulfilled our legal obligation under your policy. We have paid the $50,000 limit. The remaining claims against you are now your personal responsibility. Good luck." David is now facing a lawsuit. The family's lawyer sends a demand for payment. He owes $15,000 for the van. He owes $75,000 more for the medical bills. He is now, personally, on the hook for $90,000. A debt that came from a 2-second glance at his phone. David doesn't have $90,000 in his savings. The family's attorney gets a judgment against him in court. And with that judgment, they can legally come after his assets. They start by garnishing his wages. 25% of every paycheck he earns now goes directly to paying off this debt. His family's take-home pay is slashed. They can't afford their mortgage payments. But it gets worse. The attorney sees David owns a home. He and his wife have about $100,000 of equity built up. The attorney places a lien against the house. This means David can't sell or refinance his home without paying off the $90,000 debt first. He is trapped. The financial pressure becomes unbearable. The wage garnishment means they fall behind on their mortgage. The lien means they can't sell to downsize. Within a year, the bank forecloses. David, his wife, and his child lose their home. They lost everything. Their savings, their future income, their home. All because David tried to save $30 a month. He wasn't a bad person. He wasn't a reckless driver. He made a common mistake. But he paired that common human mistake with a catastrophic financial mistake: carrying state minimum insurance. This story isn't an exaggeration. It happens every single day in America. People who think they're insured are walking around with a financial time bomb that could detonate their entire lives with one bad turn. So what is the solution? Simple, and it costs a lot less than you think. You need to raise your liability limits. A safe, responsible starting point for most people is 100/300/100. That's 100,000 for a single person's injuries, 300,000 for all injuries in an accident, and 100,000 for property damage. This level of coverage can handle the vast majority of serious accidents. It ensures that one mistake doesn't automatically lead to bankruptcy. For anyone who owns a home or has significant savings, I'd strongly recommend going even higher, to 250/500/100. And here is the secret that insurance companies don't advertise on their homepage. The difference in cost between the pathetic state minimum and a robust, protective 100/300/100 policy is often just the price of a few cups of coffee a month. Going from a policy that guarantees financial ruin to one that provides real security might cost you $15, $20, maybe $30 more per month. The same $30 David tried to save. It is the single best investment you can make in your financial security. And for those with even more to protect, you should ask your agent about an umbrella policy. This is an extra layer of liability protection, usually sold in million-dollar increments, that sits on top of your auto and home insurance. A $1 million umbrella policy can cost as little as $200 a year, and it is the ultimate defense against a life-altering lawsuit. So we've covered how to protect yourself from a lawsuit that could take everything you own. But what happens when the accident isn't your fault? What happens when the other driver is one of those people with state minimum coverage? Or worse, no insurance at all? You could win the lawsuit and still be left with a totaled car and crippling medical bills, with no one to pay them. That's where our next mistake comes in. A mistake that leaves you completely exposed, even when you did everything right. This brings us to mistake number 3, treating uninsured and underinsured motorist coverage as an optional, throwaway add-on. You see, we spend so much time worrying about the damage we might cause to others that we forget to ask a crucial question. What happens when someone with nothing to lose, causes catastrophic damage to us? Let me tell you a story about a woman named Jessica. Jessica was the definition of responsible. She was a 32-year-old graphic designer, saving up for a down payment on a house. She drove a sensible, safe 3-year-old sedan. She never texted while driving, always used her turn signal. And she had what she thought was good insurance. She had high liability limits, just like we talked about, to protect her assets. She was doing everything right. One rainy Tuesday evening, she was on her way home from a late night at the office, stopped at a red light, listening to a podcast. Suddenly, her world exploded in a symphony of screeching tires and shattering glass. A beat-up pickup truck, going at least 50 miles per hour, failed to stop and plowed directly into the back of her car. The impact was so violent it shoved her sedan into the intersection, where it was clipped by another car. When the paramedics arrived, they had to use the jaws of life to cut her out of the wreckage. Jessica woke up in the hospital with a concussion, 3 fractured ribs, and a shattered femur that would require multiple surgeries and a titanium rod to fix. Her car, the one she was still making payments on, was a twisted heap of metal, declared a total loss. The initial hospital bill alone was over $80,000, and that was before the surgeries, the months of physical therapy, and the lost wages from being unable to work for the better part of a year. But here's the part of the story that turns a tragedy into a financial nightmare. The driver of the truck who hit her? He was a 22-year-old with a string of DUIs. He was driving on a suspended license. And you guessed it, he had absolutely zero car insurance. He was, in legal terms, judgment-proof. He had no job, no savings, no house, no assets to his name. Jessica's lawyer told her they could sue him and win easily. They could get a judgment for $500,000 or more to cover her medical bills, her lost car, and her pain and suffering. But a judgment is just a piece of paper. You can't get blood from a stone. You can't take money from someone who has none. She would never see a single cent. So Jessica turned to her own insurance company. She said, "The other guy was 100% at fault, but he has no insurance. You have to help me." And her insurance agent delivered the devastating news. "Jessica," he said, "you declined uninsured motorist coverage to save $12 a month." In that moment, Jessica's life fell apart. Her health insurance covered a portion of the hospital stay, but she was still on the hook for thousands in deductibles and copays. And it covered nothing for her lost wages, her physical pain, or the fact that she was now carless and still owed the bank $9,000 on a vehicle that was sitting in a scrapyard. All her savings, that down payment for her dream house, was wiped out in an instant. She was forced to move back in with her parents, drowning in debt, all because she unchecked a box to save the price of 2 lattes a month. This is not a scare tactic. This happens every single day in America. The Insurance Research Council estimates that 1 in every 8 drivers on the road with you right now is uninsured. That's 12.5% of all drivers. In states like Florida, Tennessee, and New Mexico, that number jumps to 1 in 5. In Mississippi, it's nearly 1 in 3. The odds that the person who hits you will be unable to pay for your damages are terrifyingly high. This is what uninsured motorist coverage, or UM, is for. It is not insurance for you. It is insurance for the person who hits you, purchased by you, because you can't trust them to have it themselves. When an uninsured driver injures you, your own UM coverage steps in and pays for your medical bills, your lost wages, and your pain and suffering, up to the limits you select. And what about the cousin of UM, underinsured motorist coverage, or UIM? This is just as important. UIM protects you when the at-fault driver does have insurance, but they only have the bare-bones state minimum. Let's say your medical bills are $100,000, but the person who hit you only has a $25,000 liability limit. Their insurance will pay out the $25,000, and then you're left with a $75,000 gap. Where does that money come from? If you have UIM coverage, it comes from your own policy. It bridges that terrifying gap between their pathetic coverage and your actual costs. So how much should you have? The answer is simple and non-negotiable. You should have uninsured and underinsured motorist limits that are identical to your own bodily injury liability limits. If you have decided that you need $250,000 in liability coverage to protect your assets from someone you might injure, what on earth would be the logic in giving yourself less protection? Are your health, your family, and your ability to earn an income worth less than a stranger's? Of course not. You are protecting your single greatest asset, your future earning potential. Some people argue, "Well, I have good health insurance, so I don't need it." That is a dangerously flawed argument. As Jessica's story shows, health insurance leaves you with deductibles and out-of-pocket maximums that can still be thousands of dollars. More importantly, your health insurance company will not write you a check every week to replace your lost income while you recover. It won't give you money for the chronic pain you now have to live with. It won't compensate you for the fact that you might never be able to work in your chosen field again. Uninsured motorist coverage can. In some states, this coverage is mandatory, but in most it's optional and you often have to sign a waiver to reject it. Insurance companies love this. They get to reduce their risk and you get to save a few bucks. Do not fall into this trap. Rejecting UM/UIM coverage is like playing Russian roulette with your entire financial future every time you get behind the wheel. It is the most expensive money you will ever save. So you've protected yourself from the financial damage you could do to others, and now you've protected yourself from the uninsured and underinsured masses who could financially ruin you. You're feeling pretty insulated, pretty safe. But there's another ticking time bomb, and this one is hidden right inside your own car loan or lease agreement. It's a mistake that can leave you thousands of dollars in debt on a car that doesn't even exist anymore. This next mistake is so common, and so financially devastating, that banks and dealerships practically rely on you making it. It happens in a small windowless office, after hours of searching, test driving, and haggling. You're exhausted, but you're also exhilarated. The smell of the new car is still in your head. You've agreed on a price, you've secured the financing, and you are just a few signatures away from getting the keys. This is the moment you let your guard down. And that's exactly what they're waiting for. You're led into the domain of the finance and insurance manager, or the F&I guy. This person is often the highest paid and most skilled salesperson in the entire dealership. Their job isn't to process your paperwork. Their job is to sell you high-margin add-ons. And the most lucrative of these are the cleverly disguised, wildly overpriced insurance products. This is mistake number 4. Falling for the dealership's insurance upsell. They'll slide a menu in front of you, or pull up a fancy screen, showing you a dizzying array of protection plans. They won't call it insurance because that sounds boring. They use words like protection, coverage, security, and peace of mind. And they are masters at making these sound not just like a good idea but an absolute necessity. The first and biggest one they'll push is the extended warranty, also known as a vehicle service contract. The pitch is compelling. Modern cars are like computers on wheels, they'll say. One small electronic part can cost thousands to fix. This plan covers you bumper to bumper, just like the factory warranty, for the next 7 years. For just $30 more a month, you'll never have to worry about a surprise repair bill again. Sounds amazing. But here's what's really happening. First, it's not a warranty. It's a service contract, a crucial legal distinction. It's an insurance policy against future repairs, and like any insurance policy, it's filled with exclusions. They'll say bumper to bumper, but the fine print will list dozens of things that aren't covered. Wear and tear items like brakes, belts, and hoses are almost always excluded. So are many of the complex electronic modules they just use to scare you. Second, the price is massively inflated. A dealership might sell you a plan for $3,000 that they bought from a third-party administrator for less than $1,000. That $2,000 difference? Pure profit. And the worst part? You're financing it. So you're not just paying $3,000, you're paying $3,000 plus interest over the life of your 5, 6, or even 7-year loan. That $30 a month add-on could cost you well over $4,000 by the time your car is paid off. The reality is, you don't have to buy it from them, and you certainly don't have to buy it now. You can buy a vehicle service contract at almost any time before your factory warranty expires, often for a much lower price from your own credit union or a reputable online provider. But they don't stop there. Next up is tire and wheel protection. The F&I manager will paint a terrifying picture of America's crumbling roads. You see these beautiful alloy wheels? One bad pothole, and that's a $1,500 replacement. And these low-profile tires? They can run you $400 each. Our plan covers all road hazards-free replacements for just $12 a month. Again, the fear tactic is powerful. But let's look at the math. That's nearly $720 over a 5-year loan. How many tires do you expect to have destroyed by potholes? The policies are also notoriously restrictive. They often won't cover cosmetic damage like curb rash, which is the most common type of wheel damage. They might require the tire to be non-reparable, and many punctures are easily patched for $20. You're paying a huge premium for a very specific and relatively unlikely type of event. Then comes the parade of smaller, but equally profitable add-ons. Key replacement. These smart keys have complex electronics. Lose one, and it can cost you $500 at the dealership to replace and reprogram it. This is often true, but the insurance policy for it might cost you $600. You are literally prepaying more than the cost of one replacement for the chance that you might lose a key. It's a terrible bet. Check your homeowner's or renter's insurance. Sometimes key loss is covered there. Or better yet, just be careful with your keys. And now we get to one of the absolute worst financial products ever invented: credit life and disability insurance. This one is sold with a heavy dose of emotion. The F&I manager gets serious. This is about protecting your family. If, God forbid, you were to pass away, this policy pays off the remaining balance of your car loan, so your family isn't burdened with the debt. Sounds noble. Sounds responsible. It is, in fact, a complete ripoff. Here's why. It's a form of life insurance where the sole beneficiary is the lender. Not your spouse, not your kids. The bank. Your family sees none of the money. Furthermore, it's what's called decreasing term insurance. As you pay down your loan, the potential payout gets smaller and smaller. But your premium stays the same. You're paying the same price for a benefit that shrinks every single month. For the price they charge for this, you could get a proper term life insurance policy with a death benefit 10 or 20 times larger that would not only pay off the car, but also help with the mortgage, groceries, and college tuition. That money would go directly to your family, who could decide how best to use it. The list goes on. Paint protection, a $500 wax job. Fabric protection, a $100 can of Scotchgard they charge you $600 for. VIN etching, a theft deterrent that police will tell you does very little, but the dealership will tell you gets you an insurance discount. A discount that is often pennies a month while they charge you hundreds of dollars for the service. So how do you escape this minefield? You walk into that F&I office armed with the single most powerful word in any negotiation. No. Before you even go to the dealership, decide that you are not buying any of these products. When they present you with the menu of options, you simply and politely say, "Thank you, but I'm not interested in any of the optional add-ons today. Could I please see the paperwork for just the car?" They are trained to overcome objections. They will push back. They'll say the bank requires it, which is a lie. They'll say it won't change your payment much, which is a classic misdirection. Don't focus on the monthly payment. Always focus on the total out-the-door price. Hold firm. I understand. I'd still like to proceed without any of the additional products. Repeat it like a mantra. Remember, you have all the power in this situation. You can walk away at any time. If they are pressuring you, it's because these products are incredibly profitable for them, and therefore a bad deal for you. And here's the ultimate secret weapon. Even if you get home and realize you made a mistake, in most states you have a right to cancel these service contracts for a full refund within a specific window, usually 30 to 60 days. They won't tell you this, but it's often right there in the fine print of the contract you signed. Escaping the dealership with your wallet intact is a major victory. But it's only half the battle, because the very next mistake happens right on your own couch, with a single click of a button, and it's a decision that can make even a small fender bender feel like a financial catastrophe. This is the deductible trap. And it's mistake number 2, gambling with a deductible you can't afford. Let's be honest, when you're shopping for car insurance online, your eyes are glued to one number, the monthly premium. It's the big, bold number at the end of the quote, and our brains are hardwired to make that number as small as possible. We see a quote for $120 a month, and right next to it, a quote for $80 a month. We feel a jolt of satisfaction. We think, I'm saving 40 bucks. I'm a genius. We click the $80 option without a second thought. But what we don't immediately register is why it's cheaper. Insurance companies are not charities. They are masters of psychology and risk. They know you want that lower number, so they give it to you. And the way they do it is by quietly increasing another number, usually tucked away in the details, your deductible. Think of a deductible like this. It is the amount of money you have to pay out of your own pocket right now in cash before your insurance company will pay a single penny. It is the price of admission to your own policy. If you have a $1,000 deductible and you get into an accident that causes $5,000 in damage, you write a check for $1,000. Your insurer covers the remaining $4,000. If the damage is $999, you pay for all of it. Your insurance company pays nothing. So when you choose that cheaper $80 premium, you might have just swapped a $500 deductible for a $2,000 deductible. You just saved $40 on your monthly bill, but you increased your immediate, out-of-pocket risk by $1,500. You've essentially made a $1,500 bet that you won't get into an accident, and you're making that bet every single month. Let me tell you about a guy named Mark. Mark was meticulous with his finances. He tracked every penny. When he bought his new car, a reliable Honda Accord, he spent a whole evening comparing insurance quotes. He found a policy that was $35 cheaper per month than the others. The catch? It had a $2,000 deductible. Mark did the math. $35 a month is $420 a year. He told himself, I'm a great driver. I haven't had an accident in 10 years. I'll just be careful, and I'll pocket that 400 bucks. He felt incredibly smart. He was hacking the system. For 11 months it worked perfectly. He'd saved $385. He was already planning what to do with the money. Then came the ice storm. It wasn't even a major one. He was driving 5 miles per hour in his own neighborhood, approaching a stop sign. He gently tapped the brakes. The car did nothing. It just slid silently, gracefully, into the back of a parked pickup truck. It was a low-speed impact, but the crunch of the plastic bumper and the crack of the headlight echoed in the frozen air. No one was hurt, thank God. But when the body shop called a few days later, the news was grim. The bumper, the grille, a headlight assembly, a sensor behind the bumper he didn't even know existed. The total cost of repair was $3,100. Mark called his insurance company, filed the claim, and felt a sense of relief. This is why you have insurance, right? The agent on the phone was perfectly pleasant. Okay, Mr. Johnson, she said. Everything looks good to go. The total is $3,100. So once you pay your $2,000 deductible to the body shop, we'll go ahead and cover the remaining $1,100. Mark went silent. $2,000. He had the $385 he'd saved. But where was the other $1,615 going to come from? He didn't have it. A recent medical bill had drained his emergency fund. He had to put the entire $2,000 repair bill on a high-interest credit card. The $35 a month he saved was now costing him over $50 a month in interest payments alone. That smart financial decision he made on his couch 11 months earlier had turned into a nightmare. He wasn't hacking the system had hacked him. Mark's story is the perfect illustration of the deductible trap. The single most important rule for choosing a deductible is this: your deductible should never be higher than the amount of cash you have in your emergency fund. Period. Don't think about your credit card limit. Don't think about borrowing from family. It needs to be the amount of money you could get your hands on tomorrow without breaking a sweat. If you only have $500 saved for emergencies, you have no business carrying a $1,000 deductible. You are playing a game of financial Russian roulette. Yes, a lower deductible means a higher premium, but you're not throwing that money away. You are buying certainty. You are buying the peace of mind of knowing that a fender bender won't push you into debt. So what's the right answer? It's not always about getting the lowest deductible possible either. If you have a healthy $10,000 emergency fund, does it make sense to pay an extra $50 a month for a $250 deductible instead of a $1,000 one? Probably not. You're paying an extra $600 a year to protect yourself from a $750 risk that you can easily afford to cover. In this case, you're better off taking the higher deductible, enjoying the lower premium, and essentially self-insuring for that first $1,000. The sweet spot, the Goldilocks zone, is a deductible that is high enough to give you significant savings on your premium, but low enough that you could write a check for it tomorrow without panicking. Here's the pro strategy. Use a deductible ladder. Start with a deductible you know you can afford right now. Maybe that's $500. Then, as you build your emergency savings, you can climb the ladder. Once you have $2,000 saved up, call your insurance company. Ask them, how much will my premium go down if I raise my collision deductible from $500 to $1,000? If they say it'll save you $30 a month, you've just given yourself a $360 a year raise, simply because you were financially responsible. You are now using your deductible as a strategic tool, not a source of anxiety. And here's another tip most people miss. You can have different deductibles for your different coverages. Your policy has two main parts that protect your car: collision and comprehensive. Collision covers, well, collisions. Comprehensive covers almost everything else. Theft, vandalism, fire, a tree branch falling on your roof, hitting a deer. You have way more control over collision-type accidents. You can drive defensively, pay attention, and reduce your risk. But you have zero control over a hailstorm or a deer jumping onto the highway. So, a smart strategy is to have a higher deductible for collision, say $1,000, which you can control more, and a lower deductible for comprehensive, say $250 or $500, for the random acts of nature you can't control. The premium difference is often surprisingly small, and it gives you tailored protection where you need it most. Choosing the right deductible isn't about finding the cheapest option. It's about being brutally honest with yourself about your financial reality. That number on the screen isn't just a number. It's a contract you make with your future self. It's a promise that on what might be one of your worst days, you can handle the first wave of the financial hit. Getting that wrong is like building a beautiful house with a faulty foundation. It looks fine on the surface, but the first storm will bring it all crashing down. So you've got your liability limits right, you've picked a smart deductible you can actually afford. You're feeling protected. You're feeling invincible. But there's a silent clause, a hidden gap in nearly every standard policy that has nothing to do with damage to your car. And it can leave you stranded, paying out of pocket for someone else's mistake. It's the one coverage most people say no to, and it's the one that can save you the most. This, my friends, is mistake number 2. Declining uninsured and underinsured motorist coverage. Sounds boring, I know. It sounds like an optional extra, a little add-on the agent tries to upsell you on. But declining this coverage is like building a beautiful, strong house and deciding not to put locks on the doors. You've done everything right to protect yourself, but you've left yourself completely vulnerable to the carelessness of others. Let me tell you about a guy named Mark. Mark is the kind of driver we all want to be. He's never had a ticket, never been in an accident. He drives a safe, reliable sedan. He saves diligently for his kids' college fund, has a great health insurance plan through his job, and always pays his bills on time. He is the definition of responsible. When he bought his car insurance, he did what most people do. He got great liability coverage to protect others, and he got collision and comprehensive to protect his car. But when the agent asked about uninsured motorist coverage, he thought, why would I need that? I have health insurance. It just seems like an extra cost. He politely said no, saving himself about $15 a month. One Tuesday afternoon, Mark was driving home from work, stopped at a red light, listening to a podcast. The light turned green. He proceeded through the intersection, and that's when his world shattered. A pickup truck, going 50 and a 35, blew through the red light and T-boned Mark's driver's side door. The impact was violent, spinning his sedan 180 degrees into a telephone pole. Mark woke up in the hospital with a concussion, 3 broken ribs, and a fractured pelvis. His car was totaled, but he was alive, and for a moment that's all that mattered. The police report was clear. The other driver was 100% at fault. He'd been texting and wasn't even aware of the red light. Mark, being the responsible person he is, assumed the process would be straightforward. The other driver's insurance would pay for his medical bills, his lost wages while he recovered, and the value of his totaled car. But then the second gut punch came. The driver of the pickup truck, a 20-year-old kid, had let his insurance lapse 2 months prior. He had 0 coverage. He also had 0 assets. No house, no savings, nothing. You can't get blood from a stone, and you can't get $250,000 in damages from someone who doesn't have it. Suddenly Mark was on his own. His collision coverage paid for his totaled car, minus his $1,000 deductible. That was the easy part. The nightmare was everything else. The ambulance ride alone was $2,000. The emergency room visit with CT scans and x-rays was over $20,000. The surgery to set his pelvis with pins and a plate was $90,000. And that was just the beginning. Ahead of him lay months of painful physical therapy, follow-up appointments, and prescription medications. But wait, you're thinking, Mark has great health insurance. And he did. But great health insurance doesn't mean free. His plan had a $5,000 deductible, which he had to pay immediately. Then, he had a 20% co-insurance on all his treatments until he hit his out-of-pocket maximum of $15,000 for the year. So, right off the bat, Mark was on the hook for $15,000 in medical bills. But the real catastrophe was the one his health insurance couldn't touch: his lost income. Mark was a skilled tradesman, and his job was physical. With a fractured pelvis, doctors told him he'd be out of work for at least 6 months, maybe longer. 6 months of no paychecks. His short-term disability from work only covered 60% of his salary, and it ran out after 3 months. The college fund he'd worked so hard to build? It started draining away to pay the mortgage. The family emergency fund? Gone in 2 months, covering groceries, utilities, and those mounting medical copays. The financial stress was suffocating, worse than the physical pain. He had done nothing wrong. He was the victim. Yet he was the one facing bankruptcy, his family's future hanging by a thread. All because he tried to save $15 a month. Now let's rewind. Let's go back to that moment with the insurance agent. But this time Mark says, yes. He adds uninsured motorist bodily injury coverage to his policy. He chooses a limit that matches his liability coverage. Let's say $250,000 per person. That extra $15 a month is now the single most important investment he has ever made. When the accident happens, the story changes completely. After it's confirmed the other driver is uninsured, Mark's own insurance company steps into the shoes of the person who hit him. That $250,000 policy is now there to make him whole again. It pays for his ambulance ride, his ER visit, his surgery. It covers his $15,000 out-of-pocket health insurance costs. But most importantly, it covers the things health insurance never will. It reimburses him for every single dollar of lost income while he's recovering. It can even compensate him for his pain and suffering, the permanent limp he might have, the trauma of the event. Instead of financial ruin, Mark gets a check that allows him to focus on one thing: healing. His savings are safe. His kid's college fund is untouched. His future is secure. That is the power of uninsured motorist, or UM coverage. But what about its twin brother, underinsured motorist, or UM? This is just as critical. Let's change the scenario slightly. Let's say the kid who hit Mark did have insurance, but he had the state minimum liability coverage. In many states, that's just $25,000 for bodily injury. Mark's medical bills and lost wages add up to $200,000. The at-fault driver's insurance company writes a check for their policy limit, $25,000, and wishes Mark the best of luck. They have fulfilled their legal obligation. Mark is still left with a $175,000 hole. This is where underinsured motorist coverage saves the day. It steps in and pays the difference between the other driver's low limit and the full cost of your damages, all the way up to your own UIM policy limit. So if Mark had $250,000 in UIM coverage, it would cover that remaining $175,000 gap, and he would once again be made whole. Do you see why this isn't an optional extra? You aren't just insuring your car. You are insuring your income. You are insuring your savings. You are insuring your entire financial life against the 1 in 8 drivers on American roads who are illegally driving without any insurance at all. In some states like Florida and Mississippi, that number is closer to 1 in 4. Every time you get behind the wheel, you are rolling the dice that the person about to make a mistake and hit you is one of the responsible ones. Uninsured motorist coverage takes that gamble off the table. It is, without a doubt, the best bargain in the entire insurance industry. For a few $100s a year, you are buying hundreds of thousands of dollars of protection for yourself and your family. Skipping it to save the cost of a weekly cup of coffee is a catastrophic financial mistake. So you've learned from Mark's story. You call your agent, you add high limits of uninsured and underinsured motorist coverage, and you feel that sense of relief that you're truly protected now. But what you don't realize is that within the fine print of your policy, there's another choice you probably made without even knowing it. It's a single setting, often just a checkbox, that insurance companies love because it saves them a fortune. But for you, it's a hidden trap that can slash your payout by tens, or even hundreds of thousands of dollars right when you need it most. It's the difference between a full recovery and a partial one, and most people have no idea which box is checked on their own policy. This hidden trap is called actual cash value, and misunderstanding it is, without a doubt, the single most financially devastating mistake you can make when insuring a new car. It's mistake number 1, not knowing how your car's value is actually calculated. See, when you read your policy, you probably assume that if your car is totaled, the insurance company will give you enough money to go buy a similar one. That seems fair, right? But that's not what a standard policy does. A standard policy pays the actual cash value, or ACV. And those 3 words are where the financial nightmare begins. Actual cash value doesn't mean what you paid for the car. It doesn't mean what a new one costs at the dealership today. It means what your car was worth the second before it was wrecked. It's the replacement cost, minus depreciation. And depreciation is the silent, invisible force that steals thousands of dollars of your car's value the moment you drive it off the lot. Let me tell you about Sarah. Sarah worked for years, saved up a $10,000 down payment, and finally bought her dream car. A brand new fully loaded SUV for $50,000. She financed the remaining $40,000. She did everything right. She got great insurance, or so she thought, with all the high liability limits we talked about. She felt secure, protected. 18 months later, she was stopped at a red light when a truck slammed into her from behind. The car was totaled, a complete loss. She was okay, thankfully, but her dream car was gone. She called her insurance company, filed the claim, and waited for the check. She figured she'd get enough to at least cover her loan, and maybe have a little left over to put down on a new car. The check that arrived was for $34,000. She stared at it in disbelief. $34,000? The car was $50,000. She called her agent, confused and angry. He explained, "Sarah, that's the actual cash value. Your SUV was a year and a half old. It had depreciated by $16,000. But the real gut punch came next. She checked her auto loan statement. After 18 months of payments, she still owed the bank $41,000. The insurance check was for $34,000. This means after she handed over the entire insurance payout to the bank, she still owed them $7,000. Let that sink in. Her dream car was a twisted heap of metal in a junkyard. She had no vehicle. Her $10,000 down payment had vanished into thin air, and she was now legally obligated to write a check for $7,000 to a bank for a car that no longer existed. She was financially ruined by a single accident that wasn't even her fault. This is what it means to be upside down or underwater on your loan. And it happens to millions of Americans every single year. They assume their insurance will make them whole, but instead it just pays off a fraction of their debt and leaves them stranded. So how do you avoid Sarah's nightmare? There are two critical shields you need to know about. The first and most common is called gap insurance. GAP stands for Guaranteed Asset Protection, and it does exactly what the name implies. It covers the gap between what your insurance company pays you, the actual cash value, and what you still owe on your loan or lease. If Sarah had gap insurance, it would have paid that $7,000 difference directly to the bank. She wouldn't be in debt. She'd be back at zero. Now, she would have still lost her $10,000 down payment, and she'd have no car, but she wouldn't be writing checks for a ghost. Gap insurance turns a financial catastrophe into just a very, very bad day. It is absolutely non-negotiable if you are financing or leasing a new vehicle, especially if you put little to no money down or have a loan term longer than 60 months. But there's a second, far more powerful option. It's the premium class of protection. It's called new car replacement coverage. This is a special add-on, an endorsement to your policy that completely changes the rules of the game. With new car replacement coverage, if your new car is totaled within a specified period, usually the first 1 to 2 years or under a certain mileage, the insurance company will not pay you the depreciated actual cash value. They will pay you the full cost to buy a brand new, current model year version of the exact same car. Let's rewind Sarah's story. Imagine if, when she bought her policy, she paid an extra, say $15 a month for new car replacement coverage. Now, when her $50,000 SUV is totaled, the phone call is completely different. The adjuster doesn't start researching used car prices. They don't calculate depreciation. They simply verify her coverage, and the company cuts a check to replace her 1.5-year-old vehicle with a brand new one. She doesn't lose her down payment. She doesn't worry about her loan. She walks back into the dealership and drives off in a brand new car, just like the one she had. She is made truly 100% whole again. That is the power of new car replacement. It's the difference between financial survival and a full recovery. Now, here's the critical advice you won't get from the guy in the financing office at the car dealership. When you buy a new car, they will almost always try to sell you gap insurance. They'll roll it into your loan, often for a price of $700, $800, even $1,000. Do not, I repeat, do not buy it from them until you have called your own auto insurance agent. In almost every case, you can add gap coverage directly to your auto policy for a fraction of the cost. We're talking $5 or $6 a month. That's $72 a year versus the $800 the dealership might charge you. And while you're on the phone with your agent, you must ask them this exact question. Do you offer new car replacement coverage? And what are the qualifications for my vehicle? Maybe it costs a little more than gap. But do the math. If you put $5,000 or $10,000 down on a new car, isn't it worth an extra $10 a month to ensure you don't lose every penny of that investment in a split-second wreck? Let's look at Mark. Mark bought a new truck, very similar to Sarah's SUV. He financed it. At the dealership, the finance manager pushed a gap policy for $900. Mark politely declined. He went home, called his insurance company, and added gap for $7 a month. But then the agent mentioned new car replacement. For his specific truck and policy, it was an extra $18 a month. Mark thought about it. An extra $18 a month is $216 a year. But his down payment was $8,000. He realized he was paying $216 to protect an $8,000 asset, plus avoid the headache of being upside down on his loan. It was a no-brainer. He added the coverage. 9 months later, a driver on their phone runs a stop sign and T-bones his truck. It's totaled. But Mark's experience is the polar opposite of Sarah's. There's no haggling. There's no shocking check for a depreciated value. His insurance company confirms the damage, honors the new car replacement clause, and in 2 weeks he's driving a brand new, current model year version of his truck. His loan is paid off and reissued for the new vehicle. His life barely misses a beat. That is the difference. It's the difference between foresight and hindsight, between a minor inconvenience and a major financial crisis. You have to decide before the accident happens which path you want to be on. Pull out your policy declarations page right now. Look for the words actual cash value. If you have a car that's less than 2 years old and you have a loan on it, and you don't see an endorsement for gap or new car replacement, you are driving with a ticking financial time bomb. Fixing this one mistake can save you from financial ruin. But even if you get all 4 of these things right, your liability, your medical payments, your uninsured motorist, and your vehicle replacement coverage, there is one final, overarching error in thinking. A mindset trap that can undo all your hard work and leave you just as vulnerable. It's the reason people end up with the wrong policy in the first place. And in our final section, we're going to expose it and show you how to build a truly ironclad financial shield for the road. This single, devastating mistake is the gravitational center of every other error we've discussed. It's the siren song that lures millions of drivers onto the financial rocks every single year. Feels smart, feels responsible, but it is the most dangerous trap in the entire insurance landscape. The number one mistake to avoid when buying car insurance is shopping on price alone. It's completely understandable why we do it. Price is a simple, clean, easy number to compare. $100 a month is clearly cheaper than $120 a month. It's a win. But coverage? Liability limits? The financial strength rating of an underwriter? That's all abstract. It's complicated. So our brains, seeking the path of least resistance, latch onto the one variable we can easily measure, the monthly premium. We treat buying insurance like buying a gallon of milk, assuming that the product is identical from brand to brand, so the only thing that matters is the price tag. But that is a catastrophic illusion. Car insurance is not a commodity. It is a promise. It is a legal and financial contract where you pay a small, certain amount of money to protect yourself from a large, uncertain, and potentially life-ruining amount of money. And the quality of that promise, the company's ability and willingness to actually pay up when disaster strikes, varies dramatically. Choosing a policy based only on price is like choosing a heart surgeon based on who offers the biggest discount. It's like buying the cheapest parachute you can find. You are entrusting your entire financial future to this promise, and focusing only on the cost is ignoring the single most important part of the equation: the value. Let me tell you a story about two people, David and Jessica. Both are in their early 30s, both have good jobs, a bit of savings, and a reliable car. It's time to renew their insurance. David is a price hunter. He spends an evening on a dozen different websites, plugging in his information, tweaking coverages to see how the numbers change. He's laser-focused on one goal: getting that monthly premium as low as humanly possible. He finds a company, one he's vaguely heard of from a catchy commercial, that beats his current insurer by $40 a month. That's almost $500 a year. He feels like a genius. He clicks buy, signs the digital paperwork, and celebrates his savings. He doesn't read the fine print. He doesn't check the company's J.D. Power Claim satisfaction rating, which is 2 stars out of 5. He doesn't look up their AM Best financial strength rating, which is a B-. He just sees the savings. Jessica, on the other hand, is a value hunter. She knows the price is important, but she also knows it's only one piece of the puzzle. She gets a few quotes online to get a baseline, but then she calls an independent insurance agent. She tells the agent about her life, her assets, her commute. The agent presents her with 3 options. The cheapest option is from the same company David chose. The agent immediately advises against it, pointing out their poor claims history and customer reviews. The most expensive option is from a premium carrier with every bell and whistle, but it's a bit more than she needs. But the middle option, it's perfect. It's $20 a month more than David's rock-bottom policy, but it's with a company that has an A+ financial rating and a 5-star claim satisfaction score. The policy includes OEM parts coverage, meaning if her car is damaged, it will be repaired with brand new parts from the original manufacturer, not cheaper aftermarket or junkyard parts. It also has a small accident forgiveness clause. Jessica sees the extra $24,000 a year not as a cost, but as an investment in certainty. She chooses the middle option. 6 months later, the inevitable happens. On a rainy Tuesday morning, both David and Jessica are involved in separate, not-at-fault accidents. A driver runs a red light and T-bones each of them. This is the moment of truth. This is when the promise gets tested. David calls his bargain insurance company. He's put on hold for 45 minutes. When he finally gets a claims adjuster, they're dismissive and unhelpful. They tell him to get a quote from one of their approved body shops, a place on the other side of town with terrible reviews. The body shop tells him the insurer is only willing to pay for used parts, and there's a long wait to get them. His rental car coverage, which he cheaped out on, only covers 10 days. The repairs take 3 weeks. David is out of pocket for a week of rental car fees. The final repair job is shoddy. The new door panel is a slightly different shade of white, and his car's value has plummeted. The entire process is a soul-crushing, stressful nightmare. He saved $500, but it cost him thousands in time, stress, and the diminished value of his car. Now let's look at Jessica. She calls the number on her insurance card. A friendly, professional agent answers on the second ring. They're empathetic. They ask if she's okay. Within an hour, a tow truck is on the scene. Her policy has a top-tier rental car benefit, so a comparable rental is waiting for her by the end of the day. She's told to take her car to any repair shop she trusts. She chooses the dealership's certified collision center. The insurance company doesn't blink. They approve the use of all new factory original OEM parts. The repair is flawless. 3 weeks later, she picks up her car good as new. The entire process was seamless. Her $20 a month investment bought her peace of mind and a quality outcome when it mattered most. That is the difference between price and value. The cheapest policy is often the most expensive mistake you can ever make. So, how do you avoid this trap? How do you build that truly ironclad financial shield we talked about? You follow a simple 5-step blueprint. First, know your worth. Before you even look at a quote, you need to take stock of your own financial life. What is your net worth? What assets, your home, your savings, your future income, are you protecting? This isn't about insuring your 10-year-old Honda. It's about shielding your entire life's work from a single bad day on the road. This knowledge is the foundation of all your decisions. Second, master the language. You don't need to be an expert, but you must understand the core components: liability, collision, comprehensive, uninsured and underinsured motorist, and PIP or MedPay. Knowing what these words mean transforms you from a passive price taker into an active, empowered consumer. It's the difference between a doctor telling you a bunch of medical jargon and you actually understanding the diagnosis. Third, strategically set your limits. Based on your worth, you set your liability limits high, far higher than the state minimum. For collision and comprehensive, you choose a deductible you can comfortably pay out of pocket tomorrow without flinching. A higher deductible here is a smart way to lower your premium, as long as you have the emergency fund to back it up. Fourth, vet your partner. This is the step David skipped. Before you buy, you investigate the insurance company. You look up their AM Best rating for financial stability. Anything less than an A should be a red flag. You read their J.D. Power and Consumer Reports claim satisfaction ratings. You read online reviews. You are hiring a company for the most important job in your financial life. Vet them like you would any other critical hire. And finally, fifth, hunt for value, not price. Now, with all this knowledge, you go shopping. You use online tools to get a broad sense of the market. But then you dig deeper. You talk to an independent agent who can offer insights you can't get from a website. You compare policies not just on their premium, but on the quality of the company, the optional coverages that matter to you, and the discounts you actually qualify for. You're looking for that sweet spot Jessica found, the intersection of excellent protection, a reliable company, and a fair price. The truth is, a great car insurance policy is one of the most incredible financial products ever invented. For a few $100s a month, it protects you from million-dollar lawsuits that could wipe you out. But that protection is only as good as the policy you build and the company that stands behind it. The next time you see that flashy commercial promising to save you hundreds of dollars in minutes, I want you to remember David. Remember that the easiest, fastest, and cheapest option is almost never the best. You have worked far too hard to build the life you have, to save, to invest, to plan for the future, only to have it all protected by the bargain bin option. Do the work. Follow the blueprint. Build a shield that is worthy of the life you're protecting. And then you can get behind the wheel with the one thing no discount can ever offer: true, unshakable peace of mind.